This Friday, we are set to get the latest PCE reading. That is the Fed's preferred measurement of inflation. That'll come just a few days before the central bank's next rate decision. Joining us right now is former Kansas City Fed President Esther George. And Esther, thank you very much for joining us this morning. Why don't we just talk a little overall about the market's expectations for a rate cut? The Fed has been saying for some time that they anticipated a rate cut in 2024. The market is betting almost in a united front that that's going to come in September. Does that sound right to you?
Well, good morning, Becky. Yeah, I think the combination of the Fed signaling that they peaked at their rates months ago and continuing to talk about rate cuts has set the market up again for high expectations around a September rate cut. And I think I'd be a bit more cautious myself. I do think the Fed is beginning to see the progress they've been looking for. We're all listening for the word confidence in their remarks to see whether they're getting close there. But I think we still have data to see that will give them the confirmation they're looking for that they can begin that process of rate reductions.
If the data goes their way and there aren't any big surprises between now and September, would you expect that they'd cut rates then?
I would expect that. I think their signal has been a strong one, that that's what they would like to do, that they are anxious to secure what many refer to as a soft landing. And so I think at the earliest possible window, I would expect September would be in focus for them.
Is the core PCE the most important data point?
Well, I think the headline, of course, is the target for them, but the core is telling them something about the momentum, about the strength of that inflation and where it's going directionally. So I do think you'll begin to hear more and more about how core is moving, how broad-based this disinflation is for them. And that's where I think the weight is going to be. That number is going to move around, as we all know. But keeping an eye on really what is the core driving them is always an important measure.
Do you think Fed policy is too restrictive here?
You know, Becky, I have not thought that. I think you see certainly areas of the economy where that restrictiveness is coming through, and that tends to be in a segment of the consumer that rely heavily on credit card debt, on auto lending, where you've seen those rates really manifest themselves. But of course, where we would typically expect to see mortgage rates and other things, people have locked in low rates. So it hasn't felt restrictive when you see how low unemployment is, when you see how strong growth has been. I think it's fair to raise the question of, is that policy really restrictive?
It's kind of a weird situation. It creates inequality to a certain extent between the haves and the have-nots. If you have a house, you're locked in a low mortgage, you're in decent shape. If you don't have a house, you are looking for a place to live or to rent or to buy. If you are looking for a new car, if you are looking to pay off debt, you're in a much trickier situation.
Absolutely. And I think to some extent, this rate environment, as past rate environments have been, can have distributional effects. Remember, we went through a long period of time with zero interest rates. And as a Fed president, I would hear very loudly from those that relied on savings and weren't getting any return then, while those that borrowed were quite happy. And of course, that's changed now. Yeah. And you see those effects coming through, particularly on a segment of the population that doesn't own assets and doesn't have those assets to earn from.
So does the Fed care about that, or is that just kind of the way the cookie crumbles? You're not going to be able to please all constituencies all the time.
Well, I think they care deeply about it, and you see them talk about it. The regional Fed presidents hear it in their regions. But the truth is, the Fed is dealing with a macro tool. And as you've often heard it described, it is a blunt tool, meaning it can't surgically help one sector and at the same time try to recalibrate demand in another. So you have to always be looking at the macro picture, even as you pay very close attention to the underlying micro elements.